Good morning, everyone, and welcome back to SugarMamma's Fireplay. Today's episode is a really important one if you have a mortgage, a large mortgage, and you have an investment property. There have been some recent changes which you may have seen on the news, on the headlines, on social media, and it's around APRA's new DTI rule. Now, there are some important things that you need to know about and understand right now so that you know whether you need to act on this or not. Because if you don't, I'm worried that there may be some regret. So, to help explain all the finer details about what this involves, why it's a concern, and what you can actually do about it so that it doesn't become a concern, we have John Micalizzi from Blue Lantern Home Loans. Now, for anyone that listens to this and thinks, oh my goodness, what do I do? Where do I go? Who can help me? Of course, John is more than happy to help. So to make it as easy as possible, I'm just going to pop John's mobile phone number and his email address in the podcast notes. So feel free to reach out to him when it's appropriate for you, obviously sooner rather than later because this is so time sensitive. And please know there is absolutely no incentive from me whatsoever should you work with John or anyone else from Blue Lantern. I'm just happy to put you in contact with someone that I have worked with for many, many years. I know and trust and have used for my own clients, family, and friends. All right, let's get into this because this is urgent. John, how are you? Thank you so much for jumping on this and helping us digest this and understand this in such a such a prompt manner. I really appreciate it, as will all of our listeners. How are you?
I'm really well, Canna, and as usual, thank you for the opportunity to discuss what you and I believe could be quite an important issue for people that are affected by the change.
And quite serious too as well. So let's get straight into it. What exactly is this new rule by APRA, the DTI rule, and why has this been introduced?
Okay, so DTI stands for debt to income ratio. So as the name suggests, the calculation is what are your total debts compared to your total income. So as a really simple example, if you're on a $100,000 gross salary and you have a $500,000 mortgage, your DTI, debt to income ratio, is 5. APRA is bringing a new rule on the 1st of February that states that deposit-taking institutions will be capped to 20% of new loans. Only 20% can have a DTI of 6 or more. Okay, so why are they doing this? So they've noticed that these high DTI loans above 6 have increased recently. And therefore, they then jump to, well, that could create weakness and vulnerability in the financial sector and in the housing market. So they've termed it almost like a pre-emptive strike. They're not going to wait until bad things happen. They're putting this in now to get ahead of the curve to try and avoid any potential problems down the track.
So it's a proactive measure, a proactive form of protection for our economy.
Yes, that's right.
And when you say gross income, is it combined gross income?
It's combined gross income. It's total income, right? So it's total income, total debt. So that would include rent, dividends, any form of income. But importantly, it includes all debts, not just your mortgage. So it includes credit card limits, HECS debts, personal loans, the whole lot.
Wow, I bet so many people didn't even know that.
Nope.
All right, who is most impacted by this rule and who, doesn't need to worry so much? And as at this point in time, assuming there are no new adjustments to this rule, who's currently sitting safe?
Okay, so the people that are sitting safe are people with a DTI less than 6. Okay, so if they're well below 6, no need to worry, no need to panic, business as usual. Although, as you and I have often talked about, that doesn't mean that you just sit there and, not review your own position. You should always be reviewing your own position, right?
Absolutely, on a regular basis.
Yeah, and with that piece of information that I've just shared about, a debt to income ratio includes all your debts. It never hurts to understand your DTI, try and reduce it, get rid of those unnecessary credit cards. HEX debt is also included. So, can you do anything about that now with the government's discount, etc. Right? So the people who it could affect is the people with a DTI above 6, right? So this could be people who, have decided to, take on a big mortgage because they want a particular property for themselves, or they're aggressively investing in property. So they are the people that it could affect. The loans that aren't affected by this rule, loans for any new construction and bridging loans.
So does this include people with a home loan, a principal place of residence that they're living in?
Yes, it could. If it's above 6, it doesn't matter whether you're owner-occupier or an investment loan, it's a blanket rule. And APRA has said they're applying that cap equally to owner-occupier loans and investor loans as well. So it'll be 20% cap owner-occupier loans and 20% cap on investment loans.
What if you've got a scenario where you've got, say, a couple working and they're planning on going down to one income to have a family? I mean, their DTI might be at the moment, sitting around, say, 4, but if with one person stopping work, say, to have a family for a year and take a year off, they could easily be tipped into this category.
Absolutely. So what would have to happen is they'd have to go to a lender that, one, hasn't reached their cap yet, and then two, when it comes to maternity leave, you have to go to a lender who allows some provision to go on maternity leave, which means that, there's rules around that, but that's probably a topic for another day.
Yeah. I mean, this is why you work with a mortgage that knows, all right, yes, you're going to fall into this category. All right, I know that this lender, that lender will potentially be able to look at your application and consider helping, obviously, step in and refinancing. This is why it's just so important to be ahead of the game and understand it. Even if it doesn't impact you immediately, it may do further down the track, particularly if you want someone not necessarily takes time out to raise a family, but also someone loses their job or decides to take some time off to maybe, go back to university or whatever it may be. I mean, there are going to be lots of different scenarios.
Absolutely. And what I often, say to people is, yes, rate is important, but each lender has different policies, right? And so if we come back to this topic, importantly, the rule only applies to authorised deposit-taking institutions. So I think major banks, anyone that takes a deposit. It doesn't apply to lenders who aren't authorised deposit-taking institutions. So there are lenders that won't be affected by this rule, right? So there are options out there.
Yeah. So it's not a panic doomsday, but it's definitely something that needs, proactive strategic planning with professional advice that knows the best way and also the cheapest way to make this happen, because a lot of people I can see are going to be, I guess, backed into a corner where they potentially need to refinance, but they may even need to look at refinancing to go from, say, an interest-only loan if they've got an investment property portfolio to perhaps principal and interest, so that they, stay within a safe zone with this, these DTI rules. Why do you think this is something, that people really need to be paying attention to right now? And I've got another question to ask you, which you may not be able to answer, but let's just focus on this. Why is this so important right now?
It's important right now if you are intending to take on new lending, right? If you want to do new lending, because, and when I say new lending, that includes property purchases, refinances, and also review and extension of interest-only periods, right? So
that's a big one. That's a huge one, because a lot of people might be listening thinking, it's fine. I don't intend on buying a new property, in the next couple of years, so we don't need to worry. But if you are on, say an interest-only term, and your term is due to expire. For example, Tom and I have an interest-only loan on an investment property, which actually I just checked the other day. It expires in April. So we need to, get some advice from you guys as to what to do and, whether we should look at changing the loan structure or looking at an extension or whatever, all the different options that might be able to come to us. So that's a huge one. I mean, everyone who's listening to this right now, jump on your internet banking and have a look at your loan terms and check out that when your terms actually end, like when they expire. And, is there something as simple as contacting the banks today and saying, can I, renew my interest-only term, or do they have to get a mortgage broker or their bank to step in and look at a new application almost?
So here's the thing, and this is a lot of people get caught out by this because I proactively have it marked when clients' interest-only periods are ending, and I reach out, say, 3 months before. And then if the client wants to extend their interest-only period, it's effectively an application. The bank reassesses your position. So it is the same information and process as if you were refinancing or getting a loan for a new property, right? And the reason is this, that people just hate that, right? But again, it's the reason is quite logical in that the bank is assessing whether you can afford again an interest-only period, because extending your interest-only period actually increases your total interest bill. And so the bank has to assess whether you can afford that. So it's, yes, people don't like it, but it is a necessary evil and it's there for the protection of people, right? So it is a reassessment. Right, that's just something that's unavoidable. You just can't call up the bank and go, "Hey, I want to extend my interest-only period." It just doesn't work like that. Okay.
But it'd be in your interest to look at doing this before the 1st of February, I imagine.
Absolutely. And I would go, like your example, I would even go to, if your interest-only period, say, is expiring, say, within 12 months, and if you wanted to extend it, I would look at it now. Because the other thing is, there's rate creep, right? So there's probably better rates available anyway at the moment. So it's probably a good time to look at it. The other critical piece here is that if you can't or don't want to extend your interest-only period, naturally your repayments roll to principal and interest repayments automatically on that.
Which is a significant increase. Like the other night I think it was Monday night, this was released, or Monday day, at dinner time, Tom and I quickly looked at the numbers as to switch our loan for this investment property from interest only to principal and interest. And it was a significant increase in our cash flow, and I think people really need to look at these numbers to understand, are they prepared, if they don't do their paperwork now and get on the phone and the front foot with the bank or the mortgage broker, to understand what the consequences of having to switch to a principal and interest loan, what it really looks like. So, I can't stress enough to everyone listening to please check your loan conditions and the finer details.
The next point here is that you need to also understand what it's called a roll to rate. So what will be your roll to principal and interest rate? And again, if you're, let's just say, had a 5-year interest only period, that loan was done 5 years ago. And in your loan contract, your roll to principal and interest rate that was negotiated 5 years ago just may be totally out of the market. So it actually can be a double hit. Not only will you go to principal and interest repayments, but then you may go to a rate that is way out of the market. So it's a double hit on cash flow.
And that then means refinancing to a whole nother lender.
Yes.
Yeah. Okay. Now, the question I wanted to ask you, and I appreciate that you may not be able to answer this, but I'm going to ask you anyway. This new limit of 20%, for the banks, let's call it, what do you think it currently is? Do you think it is, for APRA to have to come forward and say, right, there's this new cap of 20%. Do you think it's significantly higher than 20% at the moment?
No,
are there going to be a lot of people involved in this, like that fall into this scary hole?
So what APRA has said is that they've noticed a significant increase, albeit coming off a low base, right? They haven't put the numbers around what a significant increase means, but where it's come from and where it's going to are two separate things. Regardless of where the banks have been at, it's from 1st of February. All new loans, the amount of new loans done will have this cap, right? Sort of what's happened in the past, it doesn't really have a bearing. If Bank A, come 28th of February, 20% of their new loans are above 6 DTI, that's it. They've reached their cap.
How does this then impact, first homeowners?
Look, the rule applies regardless of the type of borrower. It's more that the carve-outs and the exclusions are type of loan. Like I said, it doesn't apply to bridging loans, doesn't apply to any new construction, okay? So it can affect any borrower. Now, first home buyers, usually their loan amounts are generally lower and their DTIs are generally under 6. But again, you could get a scenario of a couple who want to buy their first property, they're really keen to get into the market, and they want to push above six. Well, that they potentially get included, in
Yeah.
app as well.
All right. Okay. So everyone listening right now, what do they need to do? What do they need to be checking as they open up their internet banking? Can you talk us through the key things here?
Okay, so I'll split it into two. If you've got a pre-approval and you haven't bought a property yet, and that pre-approval is set to expire after the 1st of February, you may want to check well before that if you have to extend that pre-approval, that your borrowing capacity won't be potentially affected by this new rule, right? Because
Okay.
if you don't find a property, then you try and negotiate a property after the 1st of February, you need to understand whether you can still go in at the loan amount that you were negotiating at before. Because if you can't, well, then you have to reset your expectations. Okay, so that's critical, right? So that's for purchases of property, right? With existing loans, you need to understand, are you potentially caught by this rule? Then if you're going to do any form of new lending, right, on your existing loan, so it could be, that's including a refinance, it could be an upgrade, it could be, renovations,
Like with debt recycling, if you're
debt
looking at doing a debt
recycling,
recycling strategy.
anything, right? You need to check. You need to act now. If you want to do any new lending and you think you may be affected by this rule, you need to act now. So manage your loans by yourself. You may need to, take a day off and not go to the beach this summer and check things, or give it to me and I'll do it whilst you're at the beach. So really, the choice is yours.
And there's, just so everyone knows, there's no charge, there's no fee,
No,
you're not going to get a bill, for John's
no.
time here. John is remunerated, by the bank, so you don't need to worry about that. You're literally doing all the heavy lifting, life admin, for your clients. All right. So what else do we need to be doing here? Because I mean, even I'm panicking about this.
Well, then, first thing is don't panic. Again, have a general understanding of your DTI, but also, again, people usually leave. I get a lot of people, come January, February, New Year, they want to look at their situation again. Well, bring it forward, and again, even if in your head your rough calculation, your DTI is well under six. Doesn't matter. Look at what the calculation is saying, and look at what APRA is saying. Right. One of the other reasons they are doing this is because they're always concerned about the high indebtedness of Australian households. So do a sense check, a health check on your debts now. Again, my big bugbear is people who have 5 credit cards, they don't use them, and they've got these credit card limits that are unnecessary. Close some, bring it down. Chop them up. Things like HEX. HEX is included in the debt calculation. Is it time to pay it, now that the government is giving you the 20% discount, right? Or there are lenders who actually, if you're going to pay your HEX, if your HEX is going to pay itself naturally within the next year, they actually won't include it in your DTI calculation and in your borrowing capacity, right? So these are all the things that you need to check regardless of this rule, right? But importantly, if you believe you are affected by this rule, and I can help calculate that, and if you want to do something, act now.
And on that note of acting now, I mean, I was chatting with Adam the other day, and he was explaining to me that there is such a huge backlog with these banks processing applications. Obviously there's an influx of people looking to get into the property market. It's taking a long time to get loans approved and to get them finalized, not just new loans, even refinancing, even setting up debt recycling strategies. You cannot expect to just turn up and see a mortgage broker or see your bank and expect the whole thing to be fixed within 48 hours. It is a lengthy process. Obviously, you guys do all of the hard work, but it's not something people can expect to have fixed overnight, which is why, particularly with this backlog and the extensions and the delays, you need to get onto this literally the moment this podcast ends. You need to be picking up the phone, asking the questions, checking the expiry dates on those loans.
Yeah, look, it's a great point, and it's self-fulfilling, really, meaning that if your DTI is above 6, general rule is your scenario is probably not standard. There's probably some complexity in there, and that's where the backlog comes in. Is that the higher the complexity, some lenders, yeah, they may look at it in 2-3 days, a week, but then they may have more questions. And if your DTI is above 6, I'll guarantee you they'll have more questions. Okay. And so it's
Yeah.
that circular process of assessment which creates the backlog and length of time. And it's something that, we work, as you know, we work pretty quickly, right? But we're not the problem. We're not the issue. The issue is sometimes the lenders with their process, especially over Christmas, they're not as quick as they perhaps could or should be.
Yeah. And it's a very important point that you raise. If you do have a DTI of 6 or higher, your situation is most likely complex. There's a bit of a backstory as to, what you're doing, your goals, your strategy, the way that you're, perhaps you're self-employed. There are lots of, parts to your financial story. And this is why having an experienced mortgage broker like yourself, like Joe, like Adam, from Blue Lantern, that goes in for you on your behalf and explains, this is Peter. Peter, runs his own business. He's got 10 employees. He's got a business loan here, but he's got, an investment property portfolio here and a debt recycling strategy on the family home. You go in and do this so that it's not a matter of, computer says no, you've been declined or you've been knocked back, or yes, you have to switch to principal and interest now. You've got someone that actually you can have a human conversation with. They can go in and then talk to someone at your bank on your behalf that can have this important conversation so that you can then figure out what is the best course of action, obviously for your clients and obviously the person at heart here. So, I can't stress the power of having an experienced mortgage broker if your situation is even remotely complicated. Now, all right, John, thank you so much. I mean, I feel so much more relaxed, even though I am obviously concerned, and I've already made that phone call to Adam to get him to check, our situation to make sure we're okay. And if we do need to make a change, which I suspect we will, that we do it, in advance. But someone like yourself, can you explain to the listeners, how the process involved, how you can help and what you'll be looking out for, and how, other people can really navigate these new rules? Because my concern is that this feels like it's come out of the blue, but is this going to get worse? Are they going to get stricter potentially?
Okay. So when it comes, I'll answer the navigation part and how the process works. So navigating it, and so the process with me is, initial conversation, understanding of the scenario. Then, if we need to go to assessment, then providing the required, documents and information to allow me to do, the assessment. And again, it's pretty efficient these days. We have individual portals for people. They just upload information. It's not as big an impact on your life admin as people think, right? Because then the work is with me. Then I go away and crunch the numbers, and then can guide people as to strategies, options, etc. Okay, so that's how that navigation works, right? Sorry, what was the second part of the question?
How do you help people? And then I was I think it was something like, do you see this getting?
Do we see it getting worse? Yes. Do we see it getting worse? Okay.
Sorry, I'll just say this so you can say, maybe to start with, to answer your question, do I see this potentially getting worse because it has come out of the blue, for something like that?
Okay, to answer your question around, could this get worse? Well, the answer is yes. So this came out of the blue, right? No one, if you'd asked me at the start of the year, what new things could possibly come in, I would not have picked this one. Okay. And it will be the numbers. If that cap gets reached quickly, then APRA may get even tighter, right? And also if they're seeing that high indebtedness, still there, and then importantly, rates aren't going to drop, because now I've heard one bank with their forecast saying that they've flipped from potential rate cut next year to perhaps a rate increase in November, right? So if there's no rate cuts that's going to help people, and this continues, well, then APRA could act again. It could be, another rule.
Particularly if we have interest rate rises and we start to see more mortgage stress, kick off, and it is, it can have a domino effect. There are a flow-on effect. This could be really, I don't want to be doomsday and negative, but for a Monday morning, but there is so much danger with this. the potential trend of where this could keep going.
Yeah, that's right. So what I would speculate, what APRA has seen is that people have re-entered the buying market with these interest rate cuts that we've had this year, right? And so then people have been emboldened and are bullish and listening to the commentary around, oh, there could be even more rate cuts, right? So therefore, that's why they have gone for these high DTI loans, because they're thinking, okay, well, rates will continue dropping, I'll be fine, right? I think APRA has gone, okay, well, we're going to do something here just in case rates don't drop, right? And people's expectations are incorrect, and then they're stuck with these high DTI loans, right? So I would speculate that's probably the thinking that's gone into this from APRA, because it's pretty quick that they've come, and it came out of the blue.
Yeah, and it's a very firm figure. Like it's, only a maximum of 20% across the major banks. It's not a huge amount of people that are going to be allowed to stay in this, allowed to have a DTI of 6 or more. John, thank you so much for sharing everything with us, helping break this down, helping calm my nerves, but also, way more importantly, making our listeners aware of this so that they don't get a rude shock. They don't get placed in a position where they have to switch their loans to principal and interest, or they are in a position where they have to potentially sell and undo their hard work before it's even worked for them. So anyone listening, promise me the moment this podcast ends, which is in about 1 minute, you are jumping onto your internet banking, and then once you've worked out your total debt and where your DTI is sitting, you give John a call, or your bank or your mortgage broker, but you get this looked at sooner rather than later, keeping in mind the backlog currently with the banks in restructuring, refinancing, and of course those new home loans. John, as I said, we'll pop your notes and your details in the podcast notes for everyone. I can't thank you enough for your time. That was so incredibly helpful. Thank you so much.
Thanks, Kenna. Thank you for the opportunity.